Hi, I'm going to work through this exercise 8 on page 289 in your text. There's two parts to it. In the first instance, you've got an accounts receivable control balance of $45,000, $1,500 worth of bad debts were written off, and the provision for doubtful debts is the second entry that you have to make in order to provide the amount that you think are going to go bad, i.e. they're doubtful. Let's have a look at the entries that you have to make. So in the first instance, $1,500 worth of bad debts, that's a debit. Remember that when we've made the original sale, we would have credited accounts GST clearing, therefore we have to debit that back, and the total amount of debt that we got to credit to accounts receivable control was $1,650. Okay, so initially when the sale was made, would have been debits accounts receivable $1,650, GST clearing $150, and the sale $1,500. But that's gone bad. Therefore, we've got the reversal in terms of the bad debt. In the second part, we have to provide a new a new provision for doubtful debts, which is to be calculated 2% of $45,000, which is $900. The entry that we make is as follows. We're going to have $900 doubtful debt, which is an expense, and we're going to have this new account called provision for doubtful debts, which is a credit to that account. And I'll show you later how that looks in the balance sheet. So when we put this information into the ledgers, it looks as follows. We've got a $1,500 bad debt there, and what this profit and loss summary means is that that amount is being put against the profit and loss summary, against the income in the income statement. Again, we've got a $900 expense here, and the reason why we do this is just to clear it out for the next month. That's what we call a closing entry. And we've got a $900 credit sitting in the doubtful debts account. In the next part, in part B, we've got a complication where the provision for doubtful debts account was already existing of $800, so we provided last year. So as what happened this year, that actually $5,200 worth of bad debts were written off, which included this $800. So what we have to do in the first instance, we have to reverse the $800 first before we put in the new provision of $2,000. You'll note that we've just been given that amount rather than having to calculate it like we did in the previous example. So let's do the general journal entries for that. So the previous provision was $800, so we have to get rid of that and credit that against $800 to the bad debts account. And the new provision is $2,000, so we debit doubtful debts and we're going to credit provision for doubtful debts. Okay, that's all we do. Let's have a look at how that plays out in the general ledger. All right. You note here that we had $5,200 written off. This $800 was credited back. So therefore, the total amount that gets put into the income statement is only $4,400. You guys would have just put balance $4,400. This is just presented but differently. We've got $2,000 worth of doubtful debts. It's also expense. But have a look at how the provision for doubtful debts account works. Initially, there's $800. We took last year's balance out. Right? So it's zero at that stage, and we put in a new balance. Simple as that. How does that look in the financial report? On the income statement, this is just an extract. You've got bad debts of $4,400, your doubtful debts of $2,000, they're financial expenses. And over here in your balance sheet, under your current assets section, the accounts receivable control was $75,000 that was given. But this is the amount that we think is going to go bad, i.e. it's doubtful, therefore we've provided for it. And conservatively, we're going to collect $73,000 rather than the potential $75,000. And that's what accountants do. They're prudent, or what we call conservative. So they'd like to report a conservative figure. And that's what they do. Hopefully that's been useful to you. There'll be plenty more exercises for you to practice on. Thanks for listening.